Up to now, what we have talked about, it is based on if the parent is using the equity method. You may wonder, what if the parent is using either the initial value or the partial equity method? So what if the parent is using the initial value or the partial equity method? Actually, there's not a lot of differences here. The only major difference is we need to add star C entry in the subsequent years. Let's continue the previous example and let's look at how the consolidation worksheet will be different under the initial value and the partial equity method. So this handout should be uploaded on your island. Please go on island and download this handout. This is just a continuation of the previous example, but now we're assuming, first of all, the first page is if the parent is using the initial value method, and the next one is if the parent is using the partial equity method. So let's first look at the initial value method. If the parent is using the initial value method, first of all, the parent book will be a little bit different. So the investment account under the initial value method, investment account should always be equal to the initial investment. So again, so this example, this is a continuation of the example we went over in today's class, which is when there is control premium example. So this is based on today's class example. If the parent is using the initial value method, your investment account should always be equal to the initial investment, which is 880 in this situation. And then you're going to have dividend income. The dividend paid out by the subsidiary to the parent will be recognized as the dividend income by the parent. So the subsidiary paid 50,000 dividend in the year. And 50,000 multiplied by 80% ownership, that gives us 40,000. So 40,000 can be recognized as dividend income by the parent. And then under the initial value method, in subsequent years, the first entry we need to make is star C entry. The purpose of star C is to convert beginning of the year, the parent's return earning into what it should be under the equity method. So under the initial value method, we have 812,000. And then we need to take out all of the all of the previous year from the year of acquisition until prior to the current year. All of these periods, dividend recognized by the parent. And then we need to add back all of the net income. And then we need to take out all of the amortization. So here it's just 70,000, which is the difference between net income and dividend, and minus the 10,000 amortization, and multiply by 80%. So this difference is 48,000. So we need to increase our return earning by 48,000. In order to increase the return earning, we need to credit return earning for 48,000 and debit investment account accordingly. And everything else is just the same as what we should do under the initial value method. So it's just very similar to what we went over in previous class. And then non-controlling interest, we already went over that consolidated total. So I'm not going to go over this in more detail, but if you have any question going over this worksheet, please either send me an email or come to my office hour, and I can explain to you more about this. So maybe one thing to pay attention here is because it's under the initial value method, so we don't have the D entry. D is taken care of by your I entry here. But everything else is just, we already went over everything. And then if the parent is using the partial equity method, first of all, the parent book will be different. So here, the parent is going to recognize equity in subsidiary earnings. which is subsidiary's earnings is 90,000. And the parent has 80% of that. So that's 72,000. And we don't need to take out amortization here under the partial equity method. And the investment account. So investment account is basically your equity method, just add back amortization based on the equity method. Or we can just go through the calculation here. 880, that is the initial investment, plus the subsequent net income minus dividend. 2 years multiplied by 80%. So that gives you 968,000. And then your retained earning consolidation entry C, we use it to adjust your beginning parent's retained earning into what it should be under the equity method. And then basically to adjust it, we just need to take out 1 year's amortization multiplied by 80%. So meaning that we take out 8,000. And because retained earning, the balance is at the credit side. In order to decrease the retained earning, we need to debit 8,000 retained earning and decrease investment account by 8,000. And here, so everything else, it's just very similar to what we talked about before. So again, if you have any question, come to my office hour or send me an email. And the last thing I want to just to draw the attention to is, if you look at the last column here and the last column here, and if you compare it with the worksheet we went over earlier in today's class, those 3 columns should be exactly the same. So in other words, like again, which method you use doesn't matter. It will give you the same consolidated total numbers. So that is all for today's class.